Hello and welcome to Quidachievius Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quidachievius. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and with regular commentator and head of fixed interest research, Richard Carter, taking a well-deserved break. I'm delighted to be joined this week by our head of equity research, Chris Beckett. Welcome back, Chris. So one of the key economic reports released last week was the much anticipated UK inflation data update for April, and with it hopes that good news could potentially pave the way for the first interest rate cut as early as June. And that report saw CPI fall to 2.3% from 3.6% in March, and that was largely driven by a sharp and welcome reduction in energy prices. Chris, that was a substantial drop in inflation, and the Bank of England's 2% inflation target is within touching distance. But financial markets, and notably the bond markets, didn't seem to react that well to the news. What was your take on that inflation report, and what might it mean for the trajectory of interest rates in the foreseeable future?
Thank you. I think inflation's always going to be important to where market interest rates and what central banks are doing. So it's a critical set of numbers for the UK. And as you say, headline CPI coming down to 2.3%, it's an important milestone. And you had a lot of comments from politicians, and I know we'll talk about the election later, but on the morning of the inflation data, Rishi Sunak said this was a major moment for the UK economy with inflation back to normal. And I think, as with most politicians, his version of the truth doesn't completely stand up to scrutiny of the facts and the data. Core CPI is what we tend to look at more often. So take out the more volatile components of inflation, food and energy. Here, CPI came down from 4.2% to 3.9%. And the fall is good and what the Bank of England would want, but the fall isn't as fast as markets were expecting. And for consumers, and we all pay our gas and electricity bills, having gas prices coming down 37% year on year, electricity prices 21%, it's a good thing in terms of alleviating the cost of living crisis, giving people more money to spend. It's a positive for the UK economy. But underlying inflation levels are still higher than policymakers would like. When you have a look more into more of the detail of what's happening, goods price inflation, Bank of England and central bankers around the world have pretty much achieved what they wanted to achieve of back to stable prices. Actually, in the UK, goods price inflation has gone from about 1% inflation year on year to 1% deflation. So here, actual prices coming down of goods. It's the services side where inflation is stickier, it's still a problem. So CPI for services is 6%, was 6% in March, came down to 5.9% in April. So coming down very slowly. And here where we're talking about services, we're talking about healthcare inflation up 6.7%, restaurants and hotels up 6%. And it's not rocket science. The government agreed to the national living wage going up 10% in April, which none of us on this podcast would like to live within a minimum wage job. And it's very difficult. And those people have needed the increase to match cost of living crisis. But it's very difficult for companies employing a lot of people on lower wage jobs where that matters to avoid having to pass through those wage increases in terms of their pricing. And if you look at average earnings across the whole economy, that's still going up nearly 6% year on year. So I think there's still quite a lot of indicators to suggest that inflation hasn't been beaten in the UK. And it's those expectations and the level of economic growth that we're seeing that is good for a lot of companies that we invest in, but higher than the Bank of England would want, and doesn't really give them the reason to cut interest rates just yet. And that a similar narrative that we've got in America as well. Inflation more persistent than expected, economies more resilient than expected, labor market showing a little bit of softness, but not nearly as much as would justify immediate interest rate cuts. So net outlook as interest rates stay higher for longer, we still think they will come down, and probably this year, just not quite yet.
So it sort of very much sounds like things are moving in the right direction, but just not quite there yet. And I think that the central banks have sort of very much sort of reiterated over the sort of year or so that they're not going to be rushed to start to cut interest rates too soon. So, I mean, Chris, perhaps just moving on, one of your main areas of research expertise is the consumer focus sectors. And over the past few weeks, we've seen results from the UK retailers and most recently Marks and Spencer's, and also some of the global consumer staple companies, including Diageo and Unilever. Now, typically, we might expect demand for food and consumer staples to be more resilient than discretionary expenditure, certainly in the current economic environment. But has that been the case? Have you seen any notable trends emerge from those recent results?
Yeah, I think first thing to say is that first quarter results season, and we've had results from the bulk of companies that we follow. It's all been pretty good. 78% of American companies have beat earnings expectations. 58% of European companies, and here pan-European companies, including the UK in those data, have beat expectations. When you look at consumer companies, as you say, most of them are at the defensive end of the spectrum. We all need to eat. We all need to buy soap and cleaning products that the likes of Unilever and Reckitt Benckiser sell. So you wouldn't expect that many surprises. And fortunately, we haven't had many in the companies that I follow. All of those companies are managing a falling inflation environment. And this has come back to the inflation numbers that we were talking about. Last year was good for sales growth for consumer businesses. We all know that for when we've been shopping in supermarkets, prices have been going up very strongly, particularly last year. And those higher prices led to increased sales for those consumer businesses. It's not the highest quality sales growth coming in inflation, but the very good companies were also getting volume growth. So selling more boxes, packets of whatever they sell at a higher price and generating a better profit on the back of it. But it's only the best companies and the best categories that can put up prices to the extent that we've seen and not lose volume. The average company, normal economic relationships, you put up the price of something, people can afford less of it or choose to buy less of it because they don't think it's particularly good value. And that's what we've seen in sort of the middling type companies. We're still in a cost of living crisis. And if you look through the data, particularly consumers on lower incomes are still finding it very, very tough. They're not benefiting from the increase in asset prices, the benefits of higher interest rates on savings, the returns that we've seen on investments for the last 18 months or so. That doesn't really help lower income consumers. So where I've seen profit warnings, it's tended to be in discount stores, particularly in the US. When I talk to UK retailers, they'll talk a lot more about the benefits of sales of their more expensive ranges and what they're doing to revitalize the sales of their cheaper ranges, and seeing some consumers trade down to those categories. But if I was going to generalize about it, middle higher income consumers, you're seeing less of an impact in their spending patterns than more challenged consumers. If I look at UK retailers, and you mentioned the M&S numbers that we had last week, their food sales for the year went up 11%. And it sort of echoes what we've seen in terms of the better companies. Tesco sales were up 7%. Sainsbury's, again, 7%. You look at the UK supermarket retailers gaining share, that would include those three. Those under more private equity type ownership, Morrison's and Asda, losing a little bit of share. the German discounters finding it a little bit more difficult to take market share than they have over recent years. So those companies navigating higher inflation and reducing inflation relatively well. The staples companies, the companies producing the products that we buy in supermarkets, a little bit more mixed. Here I point down, it's a result of some categories being better than others and a result of some companies and managements being better than others. So I'd point to growth in the sales of things like snacks and crisps and the products like that, sales of soft drinks, the categories where we're inclined to buy more of. Coca-Cola sales rising 11% year on year. Unilever under new management doing a little bit better, their first quarter sales growing above 4%. When you get into the slightly more discretionary categories and companies that did very well during COVID on changing consumer trends, the likes of Diageo selling spirits, so think Scotch whiskey and gin and the like, people making cocktails at home as a trend, did them very well through the COVID years. Their supply chain got a bit overstocked. Maybe they took a little bit too much extra pricing, put up their prices a little bit too much. They've seen a slow decline in sales, but quite a big decline in volumes, particularly in some regions of the world. You've seen a slowdown in North America, supply chains overstocked in Latin America. So Diageo's volumes down 5%. So very much category specific. Some companies doing better, some exposed to slightly more discretionary areas, finding it a little bit more difficult. But over the whole market as a whole, result season was generally pretty good.
So the other big news from last week, and you sort of touched upon this already, Chris, was Rishi Sunak's decision to call a general election on the 4th of July. And Rishi had up until the end of January 2025 to call an election. And by that time, we may well have seen inflation fall further and interest rate cuts starting to filter through. And that may well have given voters more of a feel-good factor. But with Labour currently well ahead in the opinion polls, this does seem a strange time, well, at least to me, to call what seems to be a snap election. And Chris, first of all, what are your thoughts around Rishi's decision on the timing of the election? And secondly, we have discussed in previous podcasts what the outcome of a general election in the UK might mean, but now we have an actual date, it all feels much more real, and no doubt this will be a major talking point between now and the election. So unless Rishi knows something that we don't, surely Labour looks set to win. But in any case, what do you think the result of the election might mean for the economy and investors? And it's interesting to note that the utility stocks fell off sharply last week. Was that related to the election announcement, or are there other things going on in that sector?
Yeah, it's all very interesting. And it's one of the things that makes our jobs fascinating and keeps me motivated is that there's always something to look at. And we sit, what affects stock markets and what affects the success of our investments includes all of the economic data that we've been talking about, but it also includes the political environment, the geopolitical environment, and the UK election within that. It's an interesting decision for Rishi Sunak to make. I think, as you alluded to, it's probably not a vote of confidence in the UK economy. There's a suspicion that this is as good as it gets in terms of macroeconomic and feel-good factor. If the Conservatives were convinced that we were going to all feel wonderful by the end of the year on an improving economy, on falling interest rates, reduced mortgage payments and the like, he'd have waited. So I think where we are with inflation that we were talking about before having come down, he can claim success. I may dispute it, but the headline number is something for them to shout about. They've seen the benefits of economic growth in terms of the tax cuts that they've announced so far. You've got to conclude that they decided there isn't going to be a huge amount of money at the end of the year to further reduce taxes, and there isn't going to be a very big feel-good factor. The other side where it gets slightly outside of my area of expertise is more of the political calculation. If Rishi Sunak felt that he was going to have a leadership challenge over the summer, he takes out that possibility and further infighting within the Conservative Party by going to the country early. And I think if he's already looked at the opinion polls and decided, I'm going to lose whatever, and my best chance of managing that loss is to go to the country early and manage my reputation at the end of the day, I think you can rationalize, you can come up with a rational argument about why having a general election in July was the best thing for the Conservatives and Rishi Sunak personally to do. You also mentioned the opinion polls, and I think we all would agree that barring something very peculiar, come July the 5th, Keir Starmer's going to be Prime Minister. I tend to look at two forecasts rather than taking the opinion polls at face value, both using an MRP type methodology. If you look at the Electoral Calculus website, they're forecasting a Labour majority of 308. The YouGov MRP poll last week had a Labour majority of 154. So first thing to say, the level of a Labour majority isn't cast in stone. It's not a done deal. But I think the result is far more certain. I think Rishi Sunak's closing act in UK politics before he goes off into the sunset, into California or elsewhere, will be determining the number of Conservative MPs who are the people who get the first round of votes for his successor. Whether the Conservative opposition, as it will likely be, has 100 or 200 MPs matters to the future of the country. I think if you look at the outcome of the result that we see as fairly certain, the change of government doesn't have a huge impact on the economy. Both main parties are being less than honest with the population about government finances. Fiscally, there isn't actually too much to choose between them. And I think a very intelligent political calculation has led Rachel Reeves and the Labour Party to decide to stick to Conservative spending commitments so they can't be accused of being profligate. I think ultimately the country is not as rich as we would like to be to fund the investment in public services, the NHS, our infrastructure, defence, the whole list of things that the voters would like governments to spend money on. The money just isn't there for a responsible, prudent government to spend. If I go on to look at historic data about which type of political decisions or which parties in power do better for the economy, historically a change of government or a Labour government has been good for the economy. They've tended to spend a little bit more money, been a little bit more fiscally expansive, supported the economy through government spending. So you'd see their instinct of wanting to spend money generally leading to higher demand within the economy. And that's when you get to look at some sectors of the economy that might do relatively well. Probably the most obvious is the construction sector, particularly the house building element. We might finally get real planning reform. Planning in this country is always a debate between, well, most people would like to have more houses so that their children could afford one, but most people wouldn't like those houses to be built anywhere near them. So people are very hypocritical about the housing market. It does form one of Labour's top 5, what they call missions, that are going to inform their manifesto. It will be interesting to see exactly what they plan to do about trying to get more houses built and how quickly they think that they can do that. On the negative side, windfall taxes or continuing windfall taxes. How long can you have a tax before it stops being a windfall and starts being business as normal? I don't know. But continuing windfall taxes on the domestic, so North Sea oil and gas sector, not so much of an issue for the major international oil companies, but still an issue nonetheless for some of the smaller oil companies. A little bit of a negative there, but overall not much of an issue. Utility sector, you mentioned specifically. We had a couple of things going on last week. First, the election, as we're talking about. Second, National Grid launched a rights issue. One of the issues with how the utilities were privatized in the UK, they were privatized at a point where most utility companies needed to spend an awful lot of money to renew Victorian infrastructure and to provide services to a growing population, and in electricity's case, to transform the electricity supply industry to work for renewable power, which tends to be produced around the coast of the UK, as opposed to coal-fired power stations that tended to be on top of coal producing areas. So a lot of infrastructure, wrong type in the wrong place. That requires an awful lot of money that the government didn't have. That by privatizing those companies, they got the private sector to provide that money for investment. You can debate the level of that investment, how it was spent, how productive it was, but not the need for that investment and further investment. So you had National Grid reminding people of those fundamental facts of the utility sector, having a rights issue to fund their immediate investment plans, and that took the shine off the industry. I think what we're going to get in regulation after the election is probably more of a change in tone of the government caring more about the environmental implications rather than the scale of the bills that we pay for those utilities. I don't expect a wholesale change of regulation, and I definitely don't expect wholesale nationalization. Maybe the rail industry is a particular case, but across the broader utility sector, the government just don't have the money to fund the investment in utilities, and they don't have the money to take those companies back into government control, even if they wanted to. But it will be interesting to see how it plays out and how important utility regulation is to the new government.
So, Chris, we've covered a lot of ground today and a very sort of broad range of topics. So thank you very much for your insights today. And just before we draw to a close, if any listeners have any questions that they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. So to stay up to date with our thoughts on markets and current issues, please visit our website at www.quotachieveit.com. You can also see more of what we're doing at Quote Achieve, as well as watch past webinars on demand and subscribe to our weekly comment newsletter. So we'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. So thanks, Chris, once again for your time today, and to you all for listening.